Do you have incentive stock options through your employer and you're not sure what to do with this type of compensation or when you should actually exercise your incentive stock options and then subsequently sell? Hi, my name is Zach Morris with Paces Ferry Wealth Advisors, and I want to talk to you about incentive stock options and how you can optimize this type of compensation, which is arguably the most favorable from a tax perspective, but also the hardest to understand. As always, before implementing any type of tax strategy, it's always a good idea to check with your tax professional or CPA. The reason why incentive stock options are so favorable from a tax perspective is that when they're granted to you, you don't pay tax on it. When they vest, you also don't pay tax on it. In order to optimize your incentive stock options or ISOs, you want to achieve what's called a qualifying disposition. So qualifying disposition has two requirements. One is you have to hold it from 2 years from the grant date and 1 year from the date of exercise. Okay, so I'll say that again. You want to hold the option and the stock 2 years from the grant date and 1 year from the date of exercise. When you go to exercise those incentive stock options, you're only going to realize a portion of that exercise for AMT purposes only. So let me explain that. Because if you exercise it at a strike price of $100, and let's say that the current market value is $200, so there's a spread between what you're paying for the stock and what the current market value is. The only thing that gets counted for tax purposes is the difference between those two. So that's referred to as the spread element, or some professionals refer to it as the bargain element. So that spread element is then counted towards your calculation for AMT, or alternative minimum tax. If that addition of the spread element does not trigger alternative minimum tax, or AMT, you don't pay any tax on that exercise. So now you've held the position and you've exercised your incentive stock options. You've realized the spread element for AMT purposes. And for the sake of this example, let's say it didn't trigger AMT, so you didn't have to pay any additional taxes when you exercise. Then you hold the stock for 1 year from the date of exercising. So you exercise it in April, you wait until the following year on that same date, 366 days, and then you sell the stock for long-term capital gains. And that's how you're going to maximize the tax benefit of the incentive stock options. If you sell it prior to 1 year, you're going to pay, and you have a gain, you're going to pay short-term capital gains. That is what's called a non-qualified disposition. So of course you have to come up with the cash in order to buy the stock at that strike price. In order to exercise your incentive stock options, you have to come up with the cash to buy the stock, but it's worth it. And let me tell you why. Because here's 4 reasons why it's a great idea to exercise your incentive stock options to start the clock ticking so that you can get a qualified disposition. So one is you're going to maximize your tax benefit, right? So your employer gave you this benefit, incentive stock options. They could have given you non-qualified options. They could have given you RSUs, but they gave you incentive stock options. So let's take advantage of it. Let's make the best of this situation. And the way to do that is to get a qualified disposition upon the sale of that stock, right? So if you exercise it, you get to start that clock ticking. You can always sell it for a non-qualified disposition. You're not locked into having to hold it for a year. If you have a cash crunch, you can go ahead and sell it for a non-qualified disposition. If you don't exercise it, you're not going to give yourself that chance to say, okay, maybe I'll just hold it for another couple months and sell it for a qualifying disposition. So really starting that clock ticking is an important reason why you want to exercise your incentive stock options, right? So that's number 2. You get to start waiting for your long-term capital gains, right? Because you can't sell it for that favorable tax treatment until you've waited until 1 year after exercising. So number 2 is, let's start the clock ticking. Number 3 is, if you want to give the stock to charity, you have to hold it for a year in order to be able to gift it to charity and get the favorable tax treatment and get that deduction. So if you have a short-term gain, let's say you exercise it and you hold it for 6 months and you've got a massive gain from the strike price to the current market value, and you gift that to charity, you don't get to realize, or you don't get to take that deduction for tax purposes. So once you start that clock ticking and you get to a year, whether you sell it or not, you could then gift that stock to charity and get a deduction that way. Another reason to go ahead and exercise your incentive stock options is that if you plan on leaving that employer, or you've been terminated for any reason, there is a possibility that you're going to have an accelerated expiration of those incentive stock options. So if you go back and look at your options agreement, most likely you have an options agreement with your employer that they gave you when they started to give you incentive stock options, and you agreed to all the terms. In there somewhere, there may be something called an accelerated expiration upon termination, whether voluntary or involuntary, and you want to look out for that, because if you leave the employer and they have an accelerated expiration, you could actually be leaving money on the table if those incentive stock options expire. So by exercising your incentive stock options, you're starting that clock ticking for a favorable qualified disposition, which is going to be your most favorable tax treatment upon sale of that stock. And if you leave the company for any reason and you've already exercised that option, then you own the stock. So it's your stock, and it's yours to hold for however long you want to, and most definitely until you can sell it for a qualifying disposition. So now, going back to the calculation of AMT, there's a strategy that you can employ, and ask your financial advisor to work closely with your CPA in order to have the CPA calculate how much income you can realize for alternative minimum tax purposes without triggering alternative minimum tax. So they'll do the calculation and tell you, okay, you can realize up to whatever the number might be, $200,000 worth of additional income without triggering AMT. And then you can go back and cherry pick which options that you're gonna exercise, and calculating that spread element, so you know, go into it eyes wide open, that I'm only generating X amount of income for AMT purposes, because you're calculating that spread element at the time that you exercise. So one misconception that people have about their ISOs is that they don't want to exercise it because the stock is down. Now, going back to that AMT calculation, remember, it's only that spread element that's used toward your AMT. So that spread is calculated as income towards your AMT, right? So if the stock is down, let's say your strike is 100 and the stock is down, and let's say the stock's at 120. Well, that spread element is much smaller. So if you exercise it at that time, you're going to realize less spread element. You're still going to get that stock at the same strike price, right? But you're going to realize less spread element. Now, you don't want to realize it if it's below the strike price, but just because it's come down off of its peak doesn't mean that's a good reason to not exercise, because the closer it is to the strike price, the less spread element that you're going to realize. If you've enjoyed this video, please give us a thumbs up and subscribe below, and be on the lookout for more videos from this channel. Thank you.